And it's really one which has come about because my sister-in-law asked me. She's a school teacher. And the funny thing is my aunt asked me the same question, who also happens to be a school teacher. But it could have been anybody. And they said, look, I really don't know how to invest. And given that my mission for the last, God knows, 20 years since writing my various books, I'm going to give you the best bits of the books in this little broadcast. So don't buy the books; they're out of date anyway. Since writing these has been to get people to invest, I feel I've somewhat failed if my own family members haven't worked it out. Well, obviously they're not reading the books, and I'll show you how to download a free copy of this as well before the end of the broadcast. So if I had to simplify all that stuff for people who can't be bothered reading books and just want to get on with it, how would I go about it? And that's what this broadcast is about. It is what, let me just put it so it's focused not on me but on the actual information. It is how would I simplify in 5 steps, 5 easy steps on how everyone should be investing in some of the best companies in the world so that the money's working harder for them. Okay, we know all the risks. So how do we avoid the risks of just chasing headlines, gambling, which is what 99% of stock investors end up doing, and therefore they give their money to a fund manager who doesn't perform either, or to a broker, and then they blow it up. So how do we avoid those risks that 99% of people face? And that's what I'm going to cover in this very short, to the point presentation. So let's start off with the first issue, which is why would we be doing any of this anyway? Okay, so let's say you started off with a modest $10,000 or pounds, whatever it is, initial capital, and let's say you were able to save enough to add £500 a month, £500 or $500 a month. Well, if you had a whopping, we'll come to the growth issue later, and that's why people invest in the market. Let's say you manage to get 20% per annum tax-free, and there's tax-free accounts. We'll come to that in a second. And 20% should not be taken as granted, okay? Let's say it was 10%, so don't take this as assumed or guaranteed. Well, that's what your return looks like. That's the reason why people talk about it and say they want to do it. In year 0, you start off with your 10,000, which is actually what's slightly around that figure is in my son's ISA, his tax-free account. And I expect by the time he goes to university in 15 years, he'll have about, £600,000 in that by just following a 10,000 initial capital and adding 500 a month and so on and getting those. And that's why we do it. But that's easy to say. How on earth do you achieve it when, like I said, for most people, investing becomes gambling because they don't know how to do it properly. So let's remove some of the difficulties on how to do it. Okay, first of all, there's the risks. Let's just highlight the risks before I give you the 5-step guide on how to buy shares and how to know which ones to buy, how to open an account, and so on. The risks, and this is Microsoft I'm showing you, okay, which is probably the safest company I can think of, right? And even then, because it goes up and down, it's a good illustration of risk. Even with possibly the safest company in the world, there are risks. Therefore, this is a good example of what market risk involves. You might buy too many stocks, too few. So how many should you buy? I'll cover that as well. You might buy bad ones. Well, to be honest, 95% of companies are not worth buying into. They're too risky. It's the reason they're on the stock market. They're very risky. Okay, we only want the 5% which are worth buying into. In other words, which have a good probability of rising without too much volatility. So how do we find them? I'll come to that in the 5 steps that I'm going to show you. You need the money sooner. That's a risk. All of a sudden something happens. So we need to make sure we keep a pot of money in a bank account, maybe somewhere where we can get easy access to it. So I'll explain how you divide that up with the help of Goldman Sachs, one of their slides on how you should divide that up based on your age. Maybe you don't realize the risk you're taking. Sometimes people think, oh, I'll just put all my money in Tesla. I keep hearing it goes up, or in Bitcoin. Perhaps you're not aware that there's a way of measuring risk, and you discover that actually just what it's just done is not a reason to get in, but the overall volatility is a reason maybe to stay away, for instance. So we need to know how we measure that risk. And maybe you think, forget all of this, Alpesh, I'll give it to a fund manager, not realizing that very often research shows they don't do very well at all because they're taking out their fees. They're restricted, their hands are tied in terms of what they can invest in, and you end up doing far worse than you might otherwise have done. Okay, so all of those things being the case, where do we even begin? And don't forget, another risk is you might pick not only stocks that do poorly, but you might say, oh, I'll just put it in an index tracker. something which tracks the FTSE 100, which is a measure of the 100 largest UK companies, for instance. Well, as you can see here, there are many years where it does nothing, or it falls. And so you might try and time the market and get it wrong. You might say, oh, it's too expensive based on, I don't know, gut instinct. And you miss the train as the market soars. Or you might think, oh, it's really cheap, I'll get in now. And all of a sudden, everybody has also got in and they've started selling and the price falls. All of these risks you're well aware of, which is why a lot of people stay away from investing, which is no good because it means you're not making the most of the opportunities others are making the most out of, right? So again, my teacher, sister-in-law, and aunt said to me, well, I feel I'm missing out, but I'm afraid to get involved because what if I lose lots of money? I said, well, let's just have a look at how you might do it, and then you decide. Okay, at least the first thing you can do and owe to yourself, okay, the thing that you can do and owe to yourself is at least get the information, all right? Vikas, my friend, has said, free copy, what kind of Gujarati brother are you? I know, Vikas. The reason it's free, and Piyush Potter said, I'm free now, but like that free lunch that never existed. The reason I'm giving it away for free is I've made enough on royalties. Thank you very much. And I'd rather forego the pound in royalties. Okay, thank you. I mean, you can still send me a pound in royalties if you wish, which is what I'm left with after the publishers take their cut and the distributors take their cut. I'm more than happy to forego my pound in royalties to give you that education instead, Piyush. But absolutely, Piyush, feel free to send me a pound if you wish. I don't quite need it, but if it makes you feel better, thank you. Vikas, I should be charging you for sure. So let's get on with the 5 steps, okay? How do you buy and sell stocks? Step 1, we're going to cover how do you find a good, safe broker. Step 2, how do you divide your money? Step 3, knowing what to buy. Step 4, when to sell. And step 5, monitoring. And I promise you, I'm not going to take more than about 10 minutes of your time, because what I've done is I've stripped out everything from all the books, all my Financial Times columns, and you can sort of see all the books over my shoulder over there as well. I've stripped it all out. I thought, how do I simplify this for my sister-in-law? How do I simplify it for my aunt who can't be bothered reading the books and just want to get on with it? So let me just get on with those 5 steps. Step 1, finding a broker. We want one which is simple to use, regulated, so regulated in the UK, FCA, or in the US if you're watching this in the United States. I can't cover every country in the world, but I'm going to cover those 2 main ones. Investing, not trading. A lot of brokers, they're geared towards trading. They want to push you into trading, buying and selling, buying and selling. That's a whole separate webinar. That's not for my aunt. It's not for my sister-in-law. All right. We're talking about investment, so investment geared ones. We want ones which will offer global stocks, not just their own funds for which they get kickbacks. I want them to offer global stocks. They don't want you picking your own stocks. So they don't earn as much money if you do the hard work, like anything in life. If you do your own work, if you clean your own floors, guess what? The cleaner's not getting the money. Same with brokers. And we want them to be able to offer a tax-free solution, ISA and SIPPs, for instance, or 401ks. Why? Because if you have your money invested in those accounts, then it grows tax-free. So guess what? Every year, the taxman's not taking any tax from you. And over a number of years, that makes a bloody big difference, okay? That's the first thing. So how do you open a broker? And I'll give you names of some brokers in a second, which other companies have vetted. And I quite like the names as well. Anyway, they're all UK regulators. I'll give you the names of about 10 so you can pick from those. But if you're opening a brokerage account, this really puts people off. They go, oh, I don't even know how to do this, Alpesh. How do I do it? Well, when you go to one of the brokers' websites, it'll be simple. It's like opening a bank account online. It's as simple as that. You fill in your details. Okay, you fill in your details. There you go. And you add the money, you wire it across, which is why we want them to be a regulated broker we've heard of, like a Barclays or a Halifax or whatever else. Okay, so that's the first thing. Okay, as well, Vikas said, is that a photo of me behind you? I don't think it is, Vikas. I don't think it is, my friend. Pack it in, right? So you add the money in like a bank account, and it's pretty straightforward. Then it's simple to buy or sell. And this, again, puts people off. They say, well, how do I'll come to what we buy and sell, but they don't know even how easy it is to buy. So it goes, Alpesh, I don't know how many shares I should have. Let's say, for argument's sake, it was Apple or Microsoft or PayPal or Square or whatever else. I don't even know how to do it. Well, the brokers do try and make it easy for you. You click on buy, and this is the best bit. And this is the bit I want you to focus on, right? Pounds or whatever, dollars if you happen to be in America watching this. And you can write, I want to buy £1,000 worth of. So you don't need to calculate the number of shares. They'll do it for you. Okay, and you can say including charges, so the calculation becomes even easier. I want to buy £1,000, let's say, of Microsoft shares. Right? Now, always read this bit, risks of investing. Can't read that often enough. Just make sure you're familiar with costs and charges. They're not usually very expensive because it's a very competitive marketplace out there. So, and then you place a deal. Okay, and then online on your phone app or on your website, you'll be able to watch it. Simple, right? And the typical thing to get you over your fear is this is what the screen looks like. And you write £1,000 worth of shares. But that still begs the question, which stocks? How do we know how many? And so on. Okay, so here's some well-ranked brokers. Now I'm going to go through some of these. The way I pick them is I just look at, do I like the usability? All of these are regulated in the United Kingdom and therefore I would consider them safe. I'm not the one who's done the ranking. I've trusted a third party to do that. So there was no conflict of interest. I have no financial arrangements with any of these. Barclays is there, so you've got some name recognition. Halifax is there, so you've got some name recognition. Okay, AJ Bell, I happen to have an account with. Hargreaves, I happen to have an account with. I don't know anybody at those places. Interactive Investor, I don't have an account with. I happen to know the people. Fineco, I know the people. Anyway, so you've got a whole bunch of stuff out there. And you might say, well, which one should I pick? Well, go with name recognition, Halifax or Barclays. Or you might recognize some of the other names, and just go to their websites. I've not even given the URL, so you can Google it and find them. So that's the easy bit. That's the easy bit in terms of broker, how to open an account, how to buy, say, £1,000 worth of shares. But that still leaves step 2. How do you divide your money? Let's say you've got £10,000 to invest. In the case of my sister-in-law or my aunt, relatively modest sum. How do you know how to divide your money? Step 3, knowing what to buy. Right? They can't just keep calling me up. Step 4, when do you sell? That's the tough part. And step 5, how to monitor. Let's go through each one of those really quickly. How to divide your money, right? There's a million ways in which you could decide how many stocks to own and how much money to put into each. I want you to keep it simple, and I'll tell you why. Psychologists have shown the more complicated a process, the less likely you're going to follow it, and the more likely you're going to mess it up anyway. So keep it simple. And what I'm going to suggest to you, and there's evidence to support this, is 15 stocks, divide your money equally. Now, don't argue with me that, oh, no, Alpesh, I want to put a bit more in a company I like a lot more. 15's too few. I want to put it into 40 stocks. I want to, every time I read something, I'm going to buy it. Oh, I'm going to buy that. I'm going to buy it. No. Don't do that. We can argue the toss about it at some other point, but really don't do that. You'll only mess up your own portfolio and you won't make the money. Right? The most important thing about making money is getting started. To get started, keep it simple. And why did I say 15 stocks? Well, here's a simplified version of what academic research shows. It shows that once you start having more than 15 stocks, you're really not removing risk from your portfolio. The risk of it going up or down is not really changed too much beyond 15 stocks. So keep it simple. All right, if you really insist and you think you've got millions of pounds to invest, maybe go to 20, maybe 30, but really don't have too many because you won't be able to monitor it. You'll get confused, you'll procrastinate, and boom, that resolution to keep an eye on your finances and make yourself wealthier will go out of the window. Okay, so don't do it. Right? So step 2 was how to divide your money. Step 3, knowing what to buy. This is the difficult one. Like any 5-step movie, this is the dramatic part, knowing what to buy. And I'm gonna simplify this for you as well. I'm not going to just leave you with the BS people often say, which is, oh yeah, do your own research on the internet. That's bloody useless. Okay, and you wouldn't expect somebody who's written 18 bloody books on investing and they're that big to get to the point of how to know what to buy to say to you, do your own research. So let me really narrow it down. Do you choose journalists? And I'm going to give you the pros and cons of all of these. Or a bank analyst? I'll give you the pros and cons. Some of you, I'm sure, will be spitting blood when I say journalist or bank analyst or even broker. Word of mouth. Do you pick a mate down the road? Right? Or should you have your own checklist and screener? And I'm going to suggest the last one. And thankfully, there are free screeners on the internet as well, just like there are free lunches. Each time I go out with Vikas Porter, I get a free lunch because he always pays. Thank you very much. Okay, some questions from Pratik. Wait to the end, my friend, and I'll have answered all of the questions, right? So first things first, knowing what to buy. Well, first thing is, out of that 10,000, should you keep any in cash? Now, this is from Goldman Sachs Asset Management. It's a pretty good, simple calculator. If you've got, depending on how many years you've got till retirement, is how much equities you should have. of your total capital, how much you should have in fixed income. Forget the word fixed income. For fixed income, read bank account. I'm going to keep it simple for you. You're not going to buy government bonds. You're going to put it in a bank. So let's say you've got 25 years to retirement, as I believe I have, foolishly. Well, according to this, I can have as much as 100% in stocks or as little as 75% of my £10,000. So I might put all 10,000 into stocks, or I might put 7,500 into stocks and keep 2,500 in my bank account for a rainy day. Closer I get to retirement, the more is going to be in my bank account. Why? Well, because, you know, when you're young, you've got more, like I am, obviously, you've got more time to earn it back in case, like I showed you with Microsoft, it falls a few months. When you're old, you've got less time, believe it or not, and so you need it more at hand. I'm stating the obvious for many of you, but that's a good ready reckoner for you. It's a good use. So when I've written about this in my Financial Times columns as well, and the evidence from Goldman Sachs Asset Management is basically it's industry accepted. So there's no controversy there. So I'm just using them for that. So again, how do you know what to buy? Who should we trust? Well, I suggest not journalists. Whilst they are simple, problem is they're very hit and miss. It's not their livelihood. They don't tell you when to sell, and they give you seductive stories because they need you to click on their websites. What about brokers? Well, again, they're simple, but they're a bit hit and miss. It's not their livelihood. Their job is to try and get you to trade and invest, and they're pushing you emails saying, hey, well, 5 best stocks now, and they want to sound really clever because they don't want you doing it yourself. They want you giving the money to them. Don't do that. They don't tell you when to sell very often, and they've got a conflict of interest. They need to keep churning, keep coming up with stories, right? What about a fund manager? Just give it to a fund manager. Well, after all, it is their job. However, they're hit and miss, and academic research shows, and I've published it in my books, published it in the FT, they don't actually outperform the market. So leave the fund managers alone, which is why I'm coming to the conclusion I want you to do it yourself, right? Again, they don't tell you when to sell because they're managing it for you and charging you fat fees. What about the big banks, or Goldman Sachs? They can move the markets. The problem is hard to find their information, of course. Word of mouth. How about word of mouth? Like I said, you know, my mate Vikas, I could just say to him, what do you think? What do you think? Well, it's simple, but obviously it's dangerous. So avoid word of mouth, right? So then you're left with maybe the gurus, the Warren Buffetts of the world. It's simple. What does he own? Or Bill Gates? Again, the data's hard to find. So what are we left with? I'm going to give you a suggestion how I teach you to do it yourself. There are many free tools on the website, or on the internet. Here's one from Yahoo Finance. And what I'm going to suggest is this, how you find stocks yourself. You have a very simple checklist. Now, I could make this checklist a lot more complicated, but it will do. It is simple enough. It ticks all the boxes, right? Which is this. I want you to focus on UK, US stocks. Why? Because they're some of the biggest in the world, and there's a lot of data about them. And we haven't got time to discuss how you can invest in Vietnamese companies. All right. Now, there are several factors which research shows impact whether or not a share price is likely to go up. For instance, we know cheap companies or better valued companies tend to do better than expensive ones as a general rule. However, we also know some companies are cheap because they're rubbish. So we can't rely on valuation alone, but it is something we know is relevant. So I'm going to suggest on these screeners, for instance, on Yahoo Finance, there's a screener for valuation, and it's called price to earnings. Now, you can look that up yourself. All it does is it divides the profits of a company by the number of shares and says, per share, it generates this much profit. Therefore, is the share price expensive or cheap? And you can do your own research in your time, but I'm going to suggest it should be below 30. It's very simple, ready rule. It's not the only rule you can have because companies might have a low valuation and be rubbish, or they might have a very high valuation and actually keep on rising. Well, I'm afraid we're going to miss some of those because they have their own risk of being overvalued. To add to that, we're going to filter also for growth, not just valuation. We want companies which are growing because research shows companies which grow year on year do better than companies which don't grow. Now, don't get me wrong. There are some companies which have got no prospect of growing year on year, which do incredibly well because of speculation. We are not speculators. We are not gamblers, right? I want companies with dividends because research shows companies which pay dividends, in other words, pay you an income, okay, by way of dividend, tend to perform better than ones that don't. Now, there are exceptions to the rule, but we're keeping it simple. So we want companies which are undervalued, growing with dividends, and showing cash flow growth. And you can tick the boxes on a free, like I said, free screener like this on Yahoo. I'm not sponsored by Yahoo, by the way, in any shape or form, but because the screener is free and Yahoo are a big, well-known name, I know it happens to be a good one. Okay, and that'll drill down some names. Right, but that still raises a bunch of questions. When do I know when to sell? And what if the names I've never heard of? Okay, so let's go into some of that. How do we still secure ourselves? By the way, this is what, for me, it looks like. This is what it looks like for a professional who does it for a living. Okay, we get the names. This is, by the way, the Dow, which is the 30, which is only 30 companies, by the way. People don't realize the Dow Jones Industrial Average is 30 companies. And these are 30 companies of the Dow. And somebody like me will look at valuation, growth, and dividend yields, cash flow, which is what Croki measures, recent price performance, and a bunch of other metrics, and I'll green light what I like, and I'll want to make sure I've got lots and lots of greens, and then I'll narrow it down. But don't copy me. I'm training you to do it yourself. I don't want to just throw you fish. I want to teach you how to fish, but that's how it would end up looking like. Now, at this point, you shouldn't be thinking, oh, I'll give up, because it's actually quite easy. The next question becomes when to sell. So let's look at step 4 on when to sell. Right, when to sell. Again, we're going to keep it really simple. I could give you lots of complicated rules, but I'm not. I'm going to give you this very simple rule. If the price drops 25% from the highest point you bought it, since you bought it rather, or 12 months are up, whichever comes first, you sell. So either it drops 25% from the peak from when you, so if it goes up 100% and then comes down, so it's only up 75%, you sell it, right? Or 12 months are up. Maybe it just was up 10%. That's it all year long. And 12 months are up, then that's it. You get out and you repeat the process. So you've got a 12-month holding period unless it's dropped 25%. Now, the reason for that rule I've given is A, it's simple. B, it ensures if you get bumper profits that you get to keep a lot of them and you're not just holding on. C, it ensures that should it just drop, then at least you've capped your losses. What's your total risk per stock? Well, you've got 100% of your capital divided by 15 equal lots times 25% stop loss, the worst case scenario from when you bought it to dropping. Well, 1.8% of your total capital is the most you'll risk losing on any one stock. Okay, for the mathematicians out there, that's something I'm going to have to explain in a bit more detail to my aunt and my sister-in-law, but it's easy to explain once it settles in. Right, simple rule. 12 months or it drops 25% from the highest. Now, I could give you more complicated rules. I could give you a lot more complexity, but why? When in actual fact, most people would make a lot more money if they spent most of the time sitting on their hands after they've bought a stock. Okay, so we've now worked out along those steps, knowing what to buy because we did it based on the screener, when to sell, simple rule. Well, we need to monitor. Well, there's again free, wonderful tools, Google Finance, Yahoo Finance, or the broker you use to buy through. They'll tell you how you're performing. All right, they'll tell you how you're performing. Pratik's asked, do you ever rebalance your portfolio to bring it to equal weight? Pratik, I've answered your question now. You asked it beforehand, which is no need. No need, because my sell rule takes care of all of that complexity. Okay, it's as simple as that. It's as simple as that. So hopefully that's, now you might say, well, you've oversimplified. Actually, it's covered, to be honest, and this was published, and like I said, I'm not plugging it because it was published 20 odd years ago. When this was published, whoops, let's want to go into showing you that. When that was published, all of those words probably could have been summarized into what I've just told you. Okay, but that wouldn't sell a book, would it? Right? And it wouldn't certainly sell an international bestseller. My point is, books become out of date, right? Forget the books. Don't buy the books. Sadly, they too quickly become out of date unless you want some background learning instead. The 5-step rules I've given you. And if you want to download a free copy of that, and you might say, why is it free? Oh my God. Well, guess what? Feel a bit like Prince or Taylor Swift of the investing world. I'm fed up of publishers taking so much capital. Actually, more importantly, I'm on that mission to make sure that you guys learn to invest, okay? And you learn how to do it. So there's some more tools for you. Let's spotlight it. More free tools, and they're free. Yes, investing-champions.com which goes into a lot more detail on what I've explained. Now, my sister-in-law isn't going to go through it, and my aunt isn't going to go through that course material because they haven't got the time. They're going to go through the slides that I've just given. After this, I'm going to give them these slides so they can go through it. alpeshpatel.com, there's a Telegram channel I have where I update what I'm doing. Again, my aunt and sister-in-law, they love me, but they don't love me that much to listen to me every day, giving them ideas and thoughts and all. They've got better things to do. So they're not going to go into either of these tools, just so you know, right? They're not going to go into either of them because they've got better things to do. What they're going to do instead, like I said, to just in closing summarize all of that, they're going to monitor their stocks through the broker they use to buy them. Okay, they're going to sell after 12 months, or if the price has dropped 25% from the highest it's been since they bought it. Even simpler, they're going to use a screener like this. Well, probably they're going to pick up the phone to me, and I'm going to end up having to do hard work. But on that screener, and that's probably the most complicated aspect of what I've said today, they're going to checklist for this. Now, you could add more checklists, but filter, filter, filter. That's the most important thing until you end up with quality. It's like squeezing dirty water, which is what most companies are. They're dirty, awful companies which don't do very well, and making sure you only have left with the 15 purist. And I've explained sources. Well, I don't think you should be looking at journalists, brokers, fund managers, or any of these. I think you can do it yourself. I think you're better off doing it yourself. And the older you get, the more you should have in a bank account, the less you should have in stocks, right? According to Goldman Sachs and everybody else. And why do you only have 15? Well, you can, as I said, go up to 20 if you wish. But again, research shows, and I'm very research heavy, which is the flavor of the month, I guess, at the moment with the pandemic. I'm very research heavy. This is why I think roughly you should have 15, go up to 20. But the more you have, the more you're going to procrastinate and not do things. And I divide the capital equally amongst them. Okay, again, to keep it simple. And brokers, well, this is a list not compiled by me. You'll see some names you recognize. Halifax and Barclays are on there. Check those out. You want usability, whichever sites feel usable, okay, and easy to use. It's very easy to buy and sell. The trick here is get the broker to do the calculations. For instance, buy £1,000 worth, for instance, if that's 1/15 of your capital, pounds worth, okay? Not number of shares. You calculate the number of shares. You're bound to get it wrong. Let them calculate it, okay? It's as simple as that. And to open the account, just like opening a bank account. That's all it is. A broker account is just a bank account by another name. You wire money to them. They hold the money for you. And when you say, I want to buy, say, Microsoft shares, £1,000 worth, they buy them and they say, here it is, we're holding them for you, and here it is on the account. Simple as that. Charges, they'll tell you, most of them are pretty similar charge. I don't sweat about charges anymore. And like I said, want the ones which are simple and easy to use, preferably in an ISA or a SIPP, so it's all tax-free growth. We love tax-free because guess what? The money grows faster, right? And the sooner you start, the better, despite the fact, and I want to show you this, sooner you start, the better, despite the fact that you might think, oh, I've left it too late. I'm in my 40s, or I'm in my 50s, or I'm in my 60s. Well, we're all living longer. And this is some maths that I've done based on just starting off with 10,000 initially and put it into your children's ISA. Don't forget, they've got their own alliances. So my son, when he was born, I maxed out his ISA. So it's a tax-free account with the same brokers, you know, and put in 4,000 in first year. I think that was the limit, 4,800. Next year was 9,800 was the limit. And he's on this. And each month, well, I add it in one bulk sum. But if I was adding it monthly, let's say 500 a month you set aside for them, or whatever you can afford, up to the maximum allowance, which in the ISA is £20,000 per annum. Okay. And if it grows at 20% per annum, which is what I expect from my US stocks, anyway, most of my stocks are US, though they could be anywhere in the world. Right, that's where I expect. By the time he goes to university, he should have 600K left. Okay. Anyway, that's stylized. I mean, who knows? It might not be 20%. He might only get 10%. He might get 5%. Daddy might mess up for all his expertise. Well, so be it. But the point is to start and let somebody else work for you on there. Okay. Any other questions? I recommend to the current pandemic times without any change. Yeah, well, the recommendation is of a process, and the process applies regardless. And like I said earlier, one of the things we're not doing, and the mistake people make, is they say, oh, I'll try and time it. And there's a problem with timing. One is when you try and time it and you say, oh, there's a pandemic, so maybe the market's too expensive. Well, sadly, we don't know until hindsight, and then it rockets ahead. But if you're risk averse, then you shouldn't ever do something which you're not comfortable with, because that's your gut telling you this is too risky for me. So then don't do it. If you feel that at the moment, I think things are too buoyant, I'll just wait. Fine. You know, people said this to me in March, and that's a classic example. In March, they said to me, Alpesh, I think, you know, things are going to get worse. And I said, you know what? 60%, I think you're right. They will get worse. Guess what? The 40% of me which said, but they might not, and stays in the market for that reason. And that's why I pick stocks which are likely to fall the least and rebound the quickest, because I don't know, even when I think it's expensive, like in March, and it isn't, it goes up and makes all-time record highs over the next 9 months. Thank God I stayed in the market, but I always do, because I make sure the kind of companies I have are the type which are resilient, which are going to fall the least and rise the most. Well, which ones are those? That was step 3, picking stocks which are well-valued, high growth, dividend yielding, cash flow growth. There's a few other factors I use, but that's simple enough to get you guys started with. That's why, in a way, it's a man for all seasons or investment for all seasons. If we pick stocks which are good enough, quality enough, in other words, well valued, growth, cash, income, all those things I said, VGIM, remember that, value, growth, income, momentum, performance, then it should be fine in all periods. Okay, pound cross averaging, probably advisable right now. Pound cross averaging is fine. Now, somebody's mentioned pound cross averaging. Let me just explain what that is. That's where you say you've got £3,000 you want to put in Microsoft, and you say, I'll put 1,000 in this month, 1,000 next month, and 1,000 the month after. If you're risk averse, then that's good for you. Okay, if like me, you're risk loving, young, got more time, know you're going to get more capital and you can wait, then you just buy them straight away, knowing that you got 12 months and who knows. And you know what? Thankfully, I do think like that, because in March, when I thought the market might fall, but I don't try and time it in and out like that, it continued rising. And that's the thing. The number of people who said to me, oh, it's too late for, take an example, Square, Apple, Microsoft, a number of other companies, okay? I own stocks in other names you won't have heard of, like Tech Target and so on. And they say, oh, it's too late. Well, the number of times over the last 20 years, I've seen people waving on the station platform as the train of the stock goes, and they're expecting it to reverse and come back, and it never does. And they've missed that train and the next one. That's fine. If you're risk averse, you're probably happier not having taken the risk and earned the extra money. That's just the way you are. It's like everybody doesn't become a businessman, do they? Because they say to themselves, oh, it's not for me, I'd rather have a job. And that's okay as well. Stay within your own risk parameters, of course, knowing full well that you don't want to take that risk and your gut's telling you that you shouldn't. I'm not forcing you to take the risk and invest. I'm just saying, if you want to, like my aunt does with a few savings that she's got and my sister-in-law does, then this is how you do it, and this is how to be better informed as well. Hopefully I've answered all the questions, everyone. Thank you very much. I'll try and do more of these. I'll probably pick out more of the individual topics as well to go into more detail. But like I said, I wanted to create the simplest possible method I could think of in terms of, really distill everything down. And it's really difficult to actually distill everything down into just one small presentation. But hopefully you found that useful. Any other comments you've got, feel free to message me or add to the comments. I'll check the comments later, but also have a look at the final slide. Where is it? 23. You can also connect with me and find me through the free material that I put on investing-champions.com. My aunt's not going to look at that. You probably don't want to look at that, because who wants to read course material and articles and go into more in depth? You can also get a free copy of my book from there as well to download. Or go on alpeshpatel.com. You'll see you can connect with me on there. Hopefully it'll make it easier for you. Like I said, my mission for the last 20 odd years, and certainly when my wife turned to me and said, teach me how to buy shares, and I thought, oh God, well, I've completely failed in my mission to teach people how to invest. If my own wife turns around and says it to me, that she doesn't know. Okay, hopefully that was all great. Thank you all very much for being part of the evening and the presentation. Thank you all very much.